If you've been wondering how people seem to magically go from owning one property to two without saving another massive deposit, this video is going to break it all down for you. I'm Chris Moore, I'm a mortgage broker, and I've helped my clients secure over 200 million in home loans. And one of the most common questions I get is, Chris, we bought our first home 2 years ago. We absolutely love it, but how do we get to that second property without waiting another decade to save up? Here's the thing, you might think you need to save another $100,000 deposit from scratch, but that's just not the truth. What I'm going to show you today is exactly how a typical couple can go from one property to two in as little as 3 to 5 years, using something that's already sitting in their property right now. I'm going to walk you through a real case study and show you the exact numbers, the timeframes, and the 3 different strategies they could use to speed up this process. All right, let me introduce you to Jim and Sarah. They're both 32, they're a typical Australian couple, no kids, and they just bought their first home 3 years ago for $650,000. Now, they put down a 10% deposit, which was $65,000, so they've got a new mortgage of $585,000. Now, their goal is simple. They want to buy an investment property worth around $500,000. The question is, how do they get there? The simple answer is equity. And equity is simply the difference between what your property is worth and what you owe on it. So for instance, if Jim and Sarah's house is now worth $700,000 and they owe $560,000, they've got $140,000 in equity. The key to all of this though is what is called usable equity. Now, generally speaking, to avoid lender's mortgage insurance with the bank will typically let you borrow up to 80% of the value of your property. So if your house is worth $700,000, they can actually borrow up to $560,000 against it. Now, since they currently owe $560,000, they're right at that limit. But watch what happens as we go through the different scenarios. So let's say Jim and Sarah do absolutely nothing extra. They just make their minimum repayments and wait for the natural property growth to take effect. Now, if their property grows at a conservative 5% per year, which is pretty conservative for the market at the moment, here's what happens. By the 4th year, their property is going to be worth around $735,000, and the loan balance will have reduced down to around $550,000. That means that there's roughly $185,000 sitting in equity. In the 5th year, the property value increases again to $770,000, and the remaining loan is about $540,000, giving them approximately $230,000 in equity. By the 6th year, the property is worth close to $810,000, and the loan's been paid down to roughly $530,000, which means their equity has grown to about $280,000. Now, just remember, they can borrow up to 80% of the property value. So in year 6, they can borrow up to $648,000 against a property worth $810,000. They currently owe $530,000, which means they have usable equity of around $117,000. Based on those figures, that's enough for a 20% deposit on a $500,000 investment property plus the costs. So the patient approach actually gets them there in about 6 years. But what about if Jim and Sarah want to speed this up? Let's say they have the capacity to make extra repayments of $500 per month into their home loan account. Let's have a look at what changes. That extra $6,000 in repayments per year effectively means they're paying down their loan faster. And instead of owing $530,000 in year 3, they actually are only going to owe $511,000. So now their equity position is based on a property worth around $810,000, with them only owing $510,000 on the loan, which now means they have equity of roughly $300,000. At 80% of the value of the property, this means that they can borrow up to $648,000. They currently owe just over $511,000, which means that their current usable equity figure in this instance would be around $137,000. So it gets them there faster and with a bigger buffer. But here's where it gets interesting. What if Jim and Sarah decided to try and add some value to their property? Let's just say they spend 40 grand on a renovation to maybe try and update the kitchen, a bathroom, and add in a deck out the back. Well, if that renovation adds roughly 80 grand to their property value, which is totally realistic with the right improvements, watch what happens to their timeline. Instead of their property being worth $700,000 right now, it's actually worth $780,000. Fast forward 3 years with 5% growth, they're now looking at a property worth $903,000. If they'd continued with the accelerated repayments, they owe just around $511,000, which is equity of nearly $392,000. Remember, they can borrow up to 80% of the value of the home. So on $903,000, the current figure they can borrow up to is $722,000. Less what they owe, they'll have nearly $211,000 in accessible equity. This changes things substantially. They're not just looking at buying one $500,000 investment property. They could potentially look at something closer to $600,000 or even two smaller investments if they wanted to. So how do you actually access your equity? Well, there's two main ways. Option number one is through refinancing your loan. You'll generally reach out to your bank or a broker like myself and we'll arrange a new loan based on your property's current value. Now, just to be clear, we will need to get a new valuation organised, but it generally doesn't cost you anything depending on the bank. And subject to your requirements, we should be able to access the equity up to a value of 80% to avoid the lender's mortgage insurance. Option two is a straight equity release from your current bank. If there's no benefit in moving banks or if you're still happy with your current lender, we may just be able to add to your existing loan without having to go through the full refinance process. Here's what's crucial though. You want to set up this equity release on a separate loan facility. This is to ensure that your investment debt is quarantined and kept separate from your owner-occupied debt, which is not tax deductible. Trust me on this one, your accountant will love you for it as well. Now, before you get too excited, let me give you a reality check. Having equity doesn't automatically mean you can borrow more money. The bank still needs to be satisfied that you can service the additional debt that you're taking on. So, Jim and Sarah would still need to show that they can afford the repayments on both their home loan and the new investment property loan. This is where having a really good mortgage broker becomes really valuable because we work with multiple lenders to ensure we can maximize your borrowing capacity according to what you are looking to achieve. If you're confident you can implement this strategy, here's the really beautiful thing. Once you've done it once, it becomes a rinse and repeat strategy. That investment property that Sarah and Jim bought, in another 3 to 5 years, that's building equity too. Plus, their original home keeps growing in value also. If they want to go from 2 properties to 3, they'd had 2 properties building equity instead of just 1. The compound effect of this is actually pretty powerful. Look, I know this might seem overwhelming, but here's the thing. Every successful property investor started exactly where you are right now. The difference though is that they had a plan and they understood how their equity works. If you're sitting there thinking, this is great, Chris, but I really have no idea where I stand with my own property, then let's have a chat about your specific situation. We can look at your current position, work out exactly how much equity you have access to, and map out a realistic time frame for getting to that second property. You can book a time that works for you using the link in the description down below. Otherwise, I'll see you guys in the next one.